Welcome to Cherry Street Investor Education with Kavita Baratake, passive income coach and founder of Cherry Street Investments. Education that is designed for you to take control of your financial life. Join us to learn how you can create multiple passive income streams, diversify your portfolio, save on your taxes, and much more. Become a better investor and fast track your financial goals. Here's your host, Kavita Baratake.
Good evening, everyone, and thank you guys for joining in to this webinar. I'm Kavita Baratake, and I'm the principal of Cherry Street Investments. And thank you for joining this webinar on navigating multifamily investments during a market slowdown. I'm excited and honored to have my guest today, who also happens to be my friend and colleague, Ike Muttabana, who's the CEO of 110 Equity. Ike has done over 1,500 units across multifamily, and he also owns equity in industrial and other assets. He is an ex-C-suite with a master's degree, and he, like a lot of us techies who transition into real estate, is here today to talk about this very important topic, which I feel like is almost underrepresented right now, where people are still talking about multifamily deals, and I have a hard time kind of wrapping my head around how deals can still happen. It can, of course, you can have assumptions and others, but it's harder and harder once, you know, the rapid rate of increase, interest rate increases. It's becoming harder and harder to make deals work. And not just that, with existing deals, we have a lot of challenges. And some of you might have seen it if you are a multifamily investor where your cash flow is suddenly curtailed or maybe down to zero even, and you're trying to understand what's going on. I thought I was in a rate cap loan, or whatever the case might be, or bridge loan of some sort. So today we'll talk about all these topics, and it's my pleasure to introduce Ike to you guys, because he's a very foundationally strong guy, and we actually joke that he's like a lawyer. He really got his shit together. So I'm excited. I'm happy to have him on. He's very focused on it's going to be chock full of information. So hold on to your seats, and you'll walk away learning a lot today, I'm sure. So this is an educational webinar, and so we're not really trying to sell anything here. We just want you to be more educated. So if you're getting into deals right now, you can ask your sponsors better questions and make sure that a deal is representing what is, what it is in the market right now. So just a few housekeeping rules. You are mute automatically. If you have any issues, please let me know in the chat box, and also please locate the Q&A box and use that for asking any questions, just easier to track. I will send out this webinar. It's always recorded, and it will be uploaded also to YouTube if you're following me on YouTube. And please add my email just to make sure it doesn't go to the spam or promotions folder. Just a little bit about Cherry Street. I do a lot of these webinars every 2 weeks, and invite guests like Ike and others to talk about a wide range of investments, as well as taxation, estate planning, and other topics. And I also offer passive investments in real estate, so as does Ike, and also work with something called infinite banking, if you're not familiar with it. If you're interested in following, we have an investor group called Purely Passive Investor Group. We have almost 1,000 people on Facebook Investor Group, and you're welcome to follow us and join us there. I also have an investor education YouTube channel with all the webinars that I've done so far, maybe over 200 webinars, as well as I've been doing a lot of short videos, like a 1-minute segment talking about different topics. Please subscribe and help me grow this channel. And you'll also get notified if I upload any new content, which I do every week. And that's the link, bit.ly Cherry Street, or you can search Cherry Street Investor Education. Some upcoming webinars on for the next few weeks will be creative financing. Let's talk about how you can sell a finance in this market in spite of the interest rates being high. And people are continuing to buy deals with this kind of financing, right? So it's not that deals cannot be done. You just have to know how to get the deals done. We'll also talk about midterm rentals because we have a lot of folks, especially in Texas and other markets where interest rates, property taxes have gone up, and it's really not a cash flowing rental anymore. We want to learn how you can increase the cash flow on these kind of rentals with Vivian Kip Keller. We'll talk about midterm rentals, which are corporate rentals, and traveling nurse rentals. And if you have any other topic suggestions, I usually keep adding them on every 2 weeks. So please let me know. I'm happy to bring a good guest speaker to talk about that. And join us every Thursday, every other Thursday of the month at the same time, 7 Central. A little bit about me, and most of you folks know me, so I'm going to skim over this. Master's degree, just like I, tech person in real estate now, and been in real estate since 2009. Started with single family, transitioned into multifamily. I like to think of myself as like a diversified investor. I started with multifamily, but I invested a whole bunch of other assets. And I think that's especially important right now. And any downturn that you really see the diversification strategy kind of pay off for you, because some investments might stop paying, but others continue to pay. And just a few open opportunities. We have an ATM fund and a car wash fund right now. And like in the spirit of diversification, I personally invested in these assets and continues to see strong cash flow. And so I wanted to bring this to my investors. And I'm going to hand that off to Ike, and I'm done with my little spiel. Ike, take it over. Thanks for being here. Really appreciate your time. And I know there's a lot of presentation put together, but we're looking forward to what you have to share with the audience today.
No, perfect. And listen, I have to admit, to the audience here that, until yesterday, unless I'd done a breakfast with Kavita, I was under this really wrong impression that we were going to just chat. So this is a very overnight kind of put together presentation. So there's a lot of things in there that was a flow of consciousness of thought, right? Literally, that's what it is. So if there's stuff that, we need to speed up, we'll speed it up. But, we'll give it a go. It'll be fun. So
we'll learn on the go. We'll make it happen.
We'll make it happen. Yes, absolutely. And so, first of all, thanks a lot, Kavita, for inviting me. I know that you've got this very awesome investor education series going on. You've attended many of yours previous webinars. Good stuff. So thankful for being here. Grateful for your friendship, and it's going to be fun. Getting started here. So let's see. I'm going to give me a second while I share this, and there we go. And let me put this in slide share mode. Okay. Is that clearly visible, Kavita?
Perfect.
Okay. So, took a little bit of a somber tone with this picture, right? Just, we're not going to make this like doom and gloom. It's not doom and gloom by any means, okay? I think the thing we have to all keep in mind is it's just another cycle in the economic flow of our nation, of our globe, of where the market is. And for those of you who've been through these kind of cycles in the past, whether you were in real estate or not, you probably recognize that there are some similarities in how things go. The reasons why slowdowns happen are obviously different every time, but they happen on a regular schedule. In fact, this is probably the longest we've gone without a serious slowdown. So it was a little bit overdue in that sense. And, just adding on. So, Kavita did the job of putting the disclaimers together, and, got the same things here. Let's make sure that, you understand this is all education at this point. But I want to be clear about this as well, because Kavita made this remark about talking like a lawyer, but I'm not an attorney. So I'm not an attorney, I'm not an advisor, I'm not a broker dealer, I'm not a CPA, tax strategist. Everything here is based on, just experience of being in the industry, doing the work, and learning and figuring things out. And then, in consultation with my peers and with my colleagues and other business associates like Kavita, in fact. So this is all experiential in nature, okay? And a little bit about me, and I'll give a quick background. Yes, I've been in multifamily now for some time. My prior life, I was in the tech world. And then, while Kavita seems to have actually done a little bit more of a gradual transition, she started, heavily in single family, and then moved here. For me, it was a little bit more abrupt. Um, I did not do too well in real estate more than a decade plus ago, just because I ended up hitting the 2008 recession and making some decisions at that time, which didn't pan out with the recession really unfolded. So it took me a while to get back into real estate, and then now I'm a full-time real estate investor. I've been in the industry now for about 6+ years, and gone through a variety of different projects. So between past experience, in the tech and the business world as well, combining that and bringing to the fore here, has really helped ensure that as we go forward, we shape this and really ensure that as we go forward, we take a completely transparent approach to how we do business, because that's really the best way to ensure that everybody's interests are protected, including our own, not just investors, but our own as well. So let's just talk about this. What's happening, right? What's happening in multifamily and commercial real estate? This is what it feels like. Basically, debt market seems to have gone bananas. Everybody's screaming aloud, hair on fire. And that is to some extent what's really causing a lot of the chaos, right? So we'll get to that. But let's sort of drill down a little bit more. And Kavita alluded to this. So there's a lot of impacting factors on multifamily assets across the board. In fact, just before we got started here, there was someone on chat who asked, hey, in my case, it's already a fixed rate loan, it was refinanced. So what's the crisis, right? So it's not, I wouldn't call anything a crisis yet. Some particular things might go into crisis. Some things are in crisis, but it's not across the board. So if you're in a secure asset that is on a fixed rate, long-term loan, things are chugging along well, and really the debt market is having no impact on you, well, there's no crisis for you at all of any sort. And yet, if you're finding that perhaps your sponsors are holding back on cash, are pausing distributions or reducing distributions, there's reasons for that which are somewhat interlinked to the debt markets and some to just the natural slowing down in the market that's happening, right? So let's think of revenue as the first factor, right? Revenue is what drives all of it. The in-place rents are still strong. They're not. You don't see any massive amount of rent just falling through the roof here. That's not happening. In some places, some markets, perhaps rental values have gone down a little bit, but it's not catastrophic by any means at this point, right? What is definitely clearly visible in many, many markets is that organic rent growth has flattened. So this was one thing that some markets like Austin or Phoenix, these markets had some extremely crazy amount of rental growth. We saw 25%, 30%, 40% rental growth at times. It was very clear that was not sustainable. That was a direct outcome of the inflation that the economy was experiencing, right? That, with all of the tamping down by the Federal Reserve on interest rates, trying to beat inflation, automatically rental growth is also getting tampened down a little bit. But remember, this is also very market specific. There are some markets where it hasn't flattened, just the rate of growth has decreased, right? So instead of growing at 10%, maybe now it's growing at 6% or 5%. Those who were growing at 5% maybe are now growing at 2%. So it really depends on where the market was and to what extent the inflationary trend had hit the rental growth. The other area is value creation, right? I'm using the word value creation because value add is a very specific, it's used in a very specific context, but value comes in many different ways. So value creation in general is basically taking what you have today and finding ways to increase the revenue that then can percolate down to increasing the valuation of the property. That's a very standard strategy across the board. That has become harder because it's become harder to find ways in which you can add value that can bring you that additional income beyond the fact that you're already flattening out in rental growth. There has to be some correlation. If people are unable to or not willing to pay higher amounts for rent, they're likely not going to be willing to pay higher amounts for other kinds of amenities or other kinds of things you might do to increase that income, right? The place where you probably still see good value creation is in very deep renovation projects, but we'll talk about that later. It's got to be you've got to be careful. They have to be in the right location, and they have to have the right dynamics around which market, sub-market, neighborhood, strategy, all of that. The one thing that's definitely something to watch out for is the rise in delinquency. Now, this happened dramatically during the pandemic, right? When 2020 hit, across the board, the eviction moratoriums across the country, and a lot of people went out of work very suddenly. Delinquencies rose. It took a while to really start, moving that out of your books and getting back into some level of health. And that you see a small rise again that's happening, and really depends on the nature of the property and the nature of the demographic you have on the property. The properties that have demographics that are getting hit right away, you see delinquencies rising. Those properties where demographics are still in favor, where job creation is still being strong. I mean, you saw the January jobs report, the best performing report in 69 years, right? So I'm hopeful that this will not be an issue across the board, across the market, every single place. It's probably going to be in pockets, in certain types of properties, in certain types of class levels, right? But that also then goes into uncollectible revenue, right? So things like concessions. As the market slows down, vacancies are going to rise. And in order to beat those vacancies, get yourself back into occupancy levels, people are going to have to give concessions. We're doing it on some properties as well. That's uncollectible revenue, right? So it does affect your overall top line growth somewhat. So it's, as I said, it's not crisis mode yet, but there is, a slowdown happening for sure, that you got to watch out for, and just need to be aware that plays a role in it. And then correlated to this is, of course, the other aspect, which is expenses, right? Income and expenses are two things that really drive how a property performs. So expenses have definitely risen, especially post-COVID. With all of the difficulty in filling jobs, right? Just finding the right people. That automatically leads to inflationary trends in salaries. So staffing salaries have gone up. If we were budgeting on some properties at $1,300 in payroll per unit, well, that's now gone to like $1,450 in some cases, even $1,500 in some cases. So there's an inflationary impact on salaries. And at the same time, retention is also tough because of the fact that there is still difficulty in finding qualified, well-performing staff. It becomes harder to retain them, and for retaining them, then you have to give them more bonuses and more commissions, and increase their salaries as well. So that is definitely a line item that has been clearly on the rise post-COVID. It'll be hard to see this getting into control very quickly, right? Because despite the fact that the jobs report is so high, so strong, the reality is almost every indicator, every report I see, people are still finding it tough to fill positions. It's not easy. There are certain types of industries, like we're hearing of all these layoffs in the tech industry. That's different though, right? But that's probably doesn't even contribute more than, 5% of the economy. But if you look at the vast parts of the economy, there are still so many sectors that are struggling to find workers. Property management is definitely one of those. Contractor cost inflation, right? So your contractors, such as your landscapers, your plumbers, your people who will come and do irrigation, these costs have been going up as well. You want to get your monument sign changed. You want to get some flashing done on, below your roofs. There's just a lot of these small things that typically used to be, where you found labor very easily, is now becoming harder to find. And those labor costs that you do find are going up as well. There is less ability than finding for property managers to be able to use bulk pricing to make an impact here. So again, another area of inflationary trends, right? Material costs is interesting. It went up dramatically after the pandemic, right? Especially timber and a whole bunch of stone and other kinds of materials. So renovation costs or even turn costs went up almost by 2 times in some cases. That is no longer the case. You're finding materials, but on an anecdotal basis, there is some level of still price rises happening. I think that is tampering down though. So we may not have as much of a material cost issue, but we're probably still going to have a labor issue. And then the other part is delinquency mitigation, right? So this becomes a real operational expense now, with the fact that delinquencies are rising. You have to deal with the fact that you have to go after people to ensure that they're paying on time. Figure out how you're going to create payment plans for those who want to stay there. For the ones who are non-responsive, how do you pursue legal avenues to enforce your ability to ensure that you can get rents from them? Because at the end of the day, nothing is free. You're not collecting rents, you're still paying expenses. So there's expenses going into mitigating these delinquency issues as well, right? And then what are the non-controllable expenses? Things that really, you'd love to be able to find ways around them, but really, really hard. Insurance is one of them. Insurance has been a troubling issue now across the country for almost every level of asset. And in some cases, it's gone up by almost 2x. If you're able to find a way to put them into some kind of a master insurance plan, it's possible to control that a little bit. I've seen now between the properties we own, insurance costs going anywhere from 25% year over year, all the way to almost 80 or 90%. So this is one of those areas that is tough. It's the what is worst about it is that it's not just the cost of premiums that is going up, but what they're offering you is also going down. They're making you have higher deductibles. If they were offering $25,000 in deductibles for just general perils, now there's gone to $50,000 in some cases. If they were offering you 3% wind and hail damage, now that's gone up to 5%. So that's deductibles that have gone up makes the effective insurance even more expensive than it used to be, not just the premium. The other piece is property tax. So this is really specific to those states where property tax is a little bit insane, right? So Texas is one of them, Florida is another, I think South Carolina is another one. Georgia, I think depends on the county. It's a very county by county thing. So really depends on the jurisdiction, but this has been a big hurting factor that has really caused a lot of distress across the board. In fact, even before the pandemic happened, before any of this slowdown happened, I was in a deal that was almost like 5 years ago, and it got hit by such a massive property tax increase that it took us almost a year and a half of work on the revenue side to be able to recover from it and actually almost break even. People don't talk about these kind of deals. We talk about the deals that do well, and many of our deals have done great, but there are some of these deals that have struggled. Fortunately, we've never lost money, but I know some sponsors who have lost money, and property tax can play that kind of a role where if it goes out of proportion, it can really hurt you. On the flip side of it, with the slowdown happening, the potential is that those tax increases might stabilize for a little bit, right? Because it's harder now for the counties to justify jacking up your rates because they jack up the rates based on appraisals. And with the appraisals now, officially flattening out a little bit, there's a better argument against the county to be able to push back on that. So I'm hopeful that property tax is one of those things which will start becoming a little bit more possible to handle. And then there's other things you can do to try and reduce the impact of that. And then what is tied into this whole thing is natural disasters. So there's an increase of natural disasters happening. One property where we barely survived getting hit by a tornado. One property where we fortunately were not in the path of a hurricane. One property that was affected by just the fact that Texas couldn't deal with the winter extreme winter issues. And in fact, Kavita has another deal as well, which is suffered from the same thing, where
Armageddon, like when the snow thing happened, we lost almost 77 units in this property out of 315. And interestingly, what happened there was insurance was supposed to pay out, right? Like we had a $2.5 million in damages or more, and insurance paid $400,000 in bail. And we are in a lawsuit with them a year and a half later. So yeah, these are things people don't talk about, like when stuff happens. And this is the reality of multifamily operations, right? All the challenges that we encounter. But again, the focus is on the back end, right? Like, okay, let's just add value. And sometimes even if cash flow is affected, we tell investors, don't be so short-sighted. I know it looks really bad when we don't have cash flow, but we're looking at the back end and seeing, okay, how can we make this property successful in spite of the challenges? So
no, 100%. Exactly. I think, and that's the key here, right? That I think it's important for us as sponsors and operators to make sure we're transparent with our investors on what's happening. At the same time, it's very important for investors to not take a very reactionary or a panic-driven view of what's happening, right? And I'm going to make one statement at the end of my presentation. I'm going to get to that slide, which I'm not going to say right now, but that aspect of the relationship between you and your sponsor is very critical to make sure that you understand and you take the effort to understand what's happening, right? Because the sponsors can only they're going to try and explain as much as they can, but then at some level, if investors are only looking at the cash coming into their pockets and that's all they're looking at, sometimes things can look worse than they really are. They're not really that worse in many cases. You just have to be a patient person, taking a long-term view. And like almost any type of investment, given the right amount of patience and the right amount of strategic and operational diligence, you can definitely come out on top. So then let's talk about the final set of factors that are impacting performance, which are now in this market really where things are really the most difficult, right? So first is, of course, debt service, mortgage payments. I have a couple of slides I'm going to illustrate how that has really rocked a lot of the cash flow that people are looking at when they look at properties, right? Lender reserves, Kavita talked about that. Lender reserves are another area that have become really problematic. Lender reserves can typically be there for a lot of reasons. They can be there because the property doesn't produce enough of a net operating income that meets the covenants of the loan, even if it's a fixed rate loan. By the way, again, talking about somebody who talked about how it's a fixed rate loan, it's long-term, and everything is great. The problem is if the net income is not meeting the covenants that the lender requires, they're going to take some of your cash flow and keep it with them until they feel satisfied that you've gotten to a certain level of performance where they'll give it back to you. This happened a lot during COVID. In fact, in one of our properties, Kavita and I are partners in that, they actually kept 1 year of debt service with them as a lender reserve. And it took us almost, a year, almost, I think, 20 months before we were able to claw that back after hitting a whole bunch of different thresholds. So lender reserves happen for all reasons. It can happen for us something as innocuous as they want you to do a green program. And they decide that, okay, a green program is going to cost $150,000. We're going to keep $150,000 with us. You go spend your own money to go fix it and get it done, and then send us the confirmation and the proof that you've done it, and then we'll reserve. So basically, you need twice the amount of money you actually would have needed to get that thing done, right? Because they're just holding your money. So lender reserves is a very tough thing. And sometimes when you're you'll find that many sponsors deal with the issue where everything looks great up to the point you're about to close, and like 2 days before you close, the lender adds a bunch of covenants in there, and you really have no choice because they're willing to walk away, but you can't now. You're really 2 days away from closing. Everything is lined up, and they're insisting they're going to take X amount of reserve just because, right? Now, it's not right now, it's not just because. Right now, they're also doing it because of the whole debt service situation, right? Because of the fact that, especially on floating rate mortgages, there is, depending on what you've done and the kind of rate cap you have, they may or may not be satisfied with how much you are being able to get from the hedging in order to meet that. So hedging costs is another thing that hedging costs is basically buying the rate cap, and I put that in there. It's not a recurring thing; it's a one-time thing, but can become recurring if you are hedging only for short periods of time. So that's something you have to factor in. And the final thing is capital projects. Capital projects, typically in the past, what we used to do was, we had as part of the equity that we would raise, we would have a certain portion of it is budgeted for capital expenses. It would not come out of operating expenses. These days, unfortunately, because of the debt service going up, and the fact that we have to worry about keeping adequate reserves, in some cases, certain projects, we will end up using operating cash to fulfill that capital project requirement in order to keep cash reserved, right? Because it's all about cash in hand versus future cash. You're trying to hedge how you're paying out vendors. Instead of paying them in 15, 30 days, you might pay them in 45 days or 60 days. And you try to do that from operating cash. So there's a whole bunch of things you're really trying to pay very close attention to make sure that your cash management is as lean as possible. Okay, so let's. I came back to this theme because it's gone bananas. So let's see what's happening, right? We'll quickly go over. I'm not here to try and educate you on the details of loan types, but I do want to try and quickly run through these just so that I've set some context, right? So fixed rate loans, clearly, these are 5, 7, 10 years. They usually have, the rate is fixed right before closing, and you get a certain amount of time as interest only, which is IO. And then after that, it becomes principal and interest. So many loans that were interest only, they might be fixed, but now they might be reaching the point where principal and interest starts mattering because they've finished the IO period. So that is an area where even fixed rate loans might, have some difficulty if they haven't been able to get their income to be able to deal with that additional principal payment, right? Why do not a lot of people do fixed rate loans, right? It's less popular than you would think. Main reason is you typically don't get sufficient leverage. Your loan to value, LTV, for new builds, for Class A, for extremely deep value add projects, it's hard to get 60, more than 65% sometimes, and that is usually not sufficient to be able to have a healthy project, because then the amount of capital you're raising reduces returns for everybody to an extent where it's just not a project that makes sense for anybody to do. So that's where fixed rate loans become a little problematic, and they're still constrained. In fact, just about 6 months ago, I was working on a potential opportunity, and the lender comes back to me with a 51% leverage. So, of course, I let it go. There was no way to make that work, but it's a very constrained form of loan. And the other thing that hits people and has hit us as well in the past is the high prepayment penalties. There's a variety of different strategies they have for that. There's defeasance, yield maintenance. They do have step downs as well. But in general, sometimes the fact that you're getting a very low interest loan, it might be like a 2.5%, 3% that you got like 2 years ago, 3 years ago. The thing you might still get hit by is the fact that the repayment penalties might be run into millions depending on the size of the deal. So it does impact you and your final back-end returns, which is why floating rate loans are very popular, right? And there's usually two components. One component is the index rate. The index rate is really some market index that the lender chooses to use on which to base their interest, right? The most popular one these days is SOFR, which is, I forget, it's a structured overnight financing rate. I think that's what it stands for. It is the inheritor or the new kind of index that has taken over from LIBOR, which was the more popular index that used to be used in the past, which was the London Interbank overnight rate, I think. And it's I'm not going to go into description of how these rates are figured out, but just suffice it to say, SOFR is the index in the market that is most popular these days. It is collateralized using US Treasuries. So there's a direct correlation between what is happening on the US Treasuries, which is the federal funds rate, and SOFR. It's not like linear. It can vary a lot, and even within a day, SOFR can swing wildly. But that's the index rate. Then there's a lender spread. Every lender that puts their margin on top of that. These do have longer term versions, not as popular. It's usually private banks that will offer that. But their spreads are super, super high. So they're not very popular. Short term is the ones we call bridge loans, right? Those are like anywhere from 2 to 5 years. And if it's 2 or 3 years, they'll offer 1 year extensions, but where they'll increase the spread when they give you an extension. So if they're offering you a 3% spread to start with, they might make it 3.15% or 3.2% when you extend it after 2 or 3 years, right? These are very popular across the commercial real estate industry, and they provide the most leverage. I mean, I've seen leverage go all the way to 85%. I've never done that, fortunately, but I know some people who have, and that is one of those things that you have to really be cautious about, getting into deals that are over leveraged, right? So I think the maximum, we would probably look at is like 75, 77% has been the max we've looked at. But even that is a little uncomfortable at times, okay? And the other thing is they usually have very low or zero prepayment penalties, right? The prepayment usually is only for the first year. And then after that, there's a debt yield. They want a certain yield. If you give them less than that, then they'll just, try to recover that yield amount before you can pay off that loan. And these are very ideal for refinancing, right? So you've got a property that you've purchased, or you're developing, or that's class A, or that is, a major renovation. You go through that process, make it stable, create a predictable income level, the valuation becomes better. Refinancing at that point actually is very, very valuable. It's a great strategy. A lot of us have done that. A lot of people, follow that strategy. So these loans are great for that. And this is a quick example, right? This is a very simplistic example. Please excuse me. I'm not going to go into the detailed ways in which these rates are actually determined. This is a very, very simplistic example of that. So let's talk about hedging, right? This is really the big one here. The concept of hedging is really a concept of insurance in a way, right? What you're basically doing is you're buying a product that is going to insure you from wild increases in the index rates. So usually you would try to purchase it from a very reputed financial institution, such as Goldman Sachs is one of the popular ones out there. There's SMBC, there's a couple of others. And the cost is based on two things, right? The cost of buying the rate cap itself. That cost is based on the strike, which is the amount of index increase you can tolerate. So if you bought at the time when the index was, let's say, 1%, and you say that my deal works okay up to 2%, well, then your strike is 2%, right? And then the other piece of the cost is how many months or years are you hedging? Are you buying that rate cap for 6 months, 1 year, 2 years, 3 years? So the longer you buy it, the higher is the cost, because now that provider is having to take the risk of the fact that rates might go up dramatically in that longer period of time. So they're going to charge you a much higher amount, right? So the higher the strike rate, lower the cost, because that's more of risk you are taking on your head. The less the amount of months or years that you use, the lower the cost. And if the index crosses the strike rate, well, then the debt service that is beyond that strike amount is what the provider will pay your lender. Okay. Back to the same theme. But let's see what has happened. Let's see what has happened, right? So this is a little graphic that I found from this source called PMFA, where they're showing what has happened. This yellow line is the current cycle of what they've done to interest rates. And what you'll notice is, and this is from November of last year. So this is not even including the rate hikes that have happened since then, including the latest one at the end of January. But that is clearly above 4 at this point. If you notice here, the closest thing historically comes to it is 2004. And 2004, the rate increases took more than 25 months. Our Federal Reserve has done that same level of increase in less than 10 months, right? So it has been a shock to the system. And I think this is something everybody needs to understand, that it's not, if sponsors are having difficulties, it's not because they didn't plan ahead, they didn't, do the right amount of underwriting, or they didn't model things correctly. I don't know how anybody could model this, right? Because you model based on historical trends, you model based on where things have been and where you see how the Federal Reserve has actually reacted to markets. So when we saw the trend at the end of 2021 that the rates were inching up slowly, we're like, okay, let's look back and see how. So we start modeling based on the 2-year, the 2.5 year, 3-year increase. Who's going to expect that a 3-year increase is going to happen in 10 months? It's a very different scenario altogether, right? So then what has happened to SOFR because of that, right? SOFR, and this is the 12 months of 2022, just 1 year. This is where, and slightly above 0% was where it was at the start of last year. This is where it ended over 4% at the end of last year. And now it's, closer to 4.5. I think it's crossed 4.5.
5.5, yeah.
Yeah. This is a table of the rates as they've gone up. And if you look at the highs, it's an incredible kind of jump, right? You've gone from 0.05% in January all the way to 4.32% at the end of December. So what has this done, right? So think about it for debt payments on the properties in which you've invested or which you're an operator on. And I've made up some numbers here. This is all illustrative in nature, made up some numbers. I just took these numbers, and I'm not going to read everything out, but if you look here in January, if the total interest rate was 3.2 because of the close to zero SOFR, your interest payment was about 26,000, right? This is an illustrative number, as I said. By the time you got to the end of the year, that had almost gone up by 3 times. Your debt payment on a monthly basis had gone up by 3 times, right? So if you want to do some more understanding of what has happened here. So I took some illustrative thing. I said 14 million asset value, a 10 million loan, which is just about 70%, 4.5 market cap, which is still okay. It depends on the class level. For the class B, class C, the market cap actually has gone up higher, but class A is still trading in the 4.5 to 5 range at the moment. And if your monthly NOI at that cap was 52,500, and let's say you did a 3% improvement in rent income for the year, right? Just being super conservative, your monthly NOI went to 54,000, but your cash flow went from 25,800 per month to negative 8,000, right? This is without any rate caps in place. Now, if you did have a rate cap in place, hedging effect, right? So here is where I said, all right, let's say we purchase a rate cap with a strike of 1.75. I chose 1.75 for a specific reason, just to show something, that the rate capped amount is 53,000 based on this. And now the cash flow is only $1,000. And your rate cap provider is paying 9,000 to your lender to make up for that difference, right? So you're safe because you're not having to be negative cash flow just because of the debt payment. However, this is when I took this very strategic 1.75% strike. If I had taken a lower strike, I would have had more cash flow. If by chance I had done 2%, I would have had negative cash flow right now, despite the fact of have a rate cap in place. So really, just the fact that you have a rate cap is not enough. What we need to know is, what rate cap did you bet on? It was a gamble, right? It was a bet. Most lenders, when we were closing our projects over the last 2 years, basically put the rate cap hedging requirement at 2.5% strike. So if imagine if we had done 2.5% on every property, we would be cash flow negative on every property right now. And fortunately, we didn't do that. We've done lower. We've done like anywhere from 0.5 to 1.5. So we're still cash flow positive. We're in the money, as it's called, where we're still positive. The provider is paying the lender. But if you're finding that the deals you've invested in, this is where sponsors, this is where operators are, what they're dealing with, this is exactly why. This is why a rate cap by itself is not a panacea for the entire situation, right? It depends on what they've done. And then the other piece of it is for how long. So there's some projects where you might have taken it for 1 year, for some for 2 years, some for 3 years. Well, depending on how long and when your rate cap expires, you may have to deal with that expiration and what you're going to do. And for those rate caps that are expiring this year, as is the case for at least one of my projects, the same rate cap that we purchased for $100,000 a year and a half ago is now costing us almost $2 million. So if I had to extend it just for a year, so obviously I can do that. But the question then is, can I hedge that a little bit higher, not have as much cash flow, not be as much in the money, but still stay within a parameter where I'm not cash flow negative? And yes, we can. Fortunately, our particular project is in that situation where, if we were to reduce the amount of sort of not have the same strike rate, but have a higher strike rate, we might, we should be able to still stay cash flow positive. What if a rate cap was not purchased?
Ike, I want to add something here, which is very interesting for our projects. I'm going to speak about a couple of them. There are two issues, right? Where even though we have a rate cap purchased, we still pay the lender the full interest, right? And the rate cap reimbursements coming back 30 to 60 days later.
Correct.
So that kind of hurts our cash flow. We thinking, oh, it's great, we have a rate cap, but now we have a lag in our reimbursement there. That's one problem, right? That affects cash flow. Now we don't have as much cash as we thought we would.
Right.
So,
and that's the problem.
Right. And the second problem we are seeing is that some of these lenders, depends on who we worked with, they require rate cap escrows, even though it's expiring, let's say, a year and a half out. Right. They are taking the escrows right now, assuming that we'll renew at the same strike, right? And that strike costs an arm and a leg. What used to cost 100,000 costs 2 million. Now they divide the 2 million by, let's say, 18 months or whatever we have left. And they take those reserves, which is the rate cap reserves right now, and they just deduct it out of our bank accounts. So we don't really have a choice. That's like a reserve that they need. And now what we thought was, okay, we don't really need a rate cap. We are good for 18 months. Before that, we'll do something different for the project, whether we sell it or we refi it. Now we are forced to escrow all these amounts, and any amount we thought, any cash flow we thought we had, we don't have anymore. So
no, that's a great point. Both are great points. And fortunately, I have not had any project where we've suffered from the second situation. I do know some sponsors who are in that situation, but we definitely suffer from the first one that you described, where they take the full amount from you as escrow, and then you have to wait for 45 to 60 days before you get the rate cap paid off. In some cases, fortunately, we've been lucky where they're actually paying it off within a week. Wow. But that is not the case everywhere. So that cash flow management has become also a trickier thing, right? Which also goes into why many sponsors have paused or reduced their distributions. At the end of the day, you have to look at the health of the property first. That's your fiduciary responsibility, right? So, but this is another thing. I did not realize this, but I have now run across multiple sponsors, operators who never purchased a rate cap. they just took a little bit of a cowboy approach, and they thought, we'll just do the modeling based on not having a rate cap. We'll assume that, as I showed the graphs, that it's going to take them 2-3 years before they raise that to a level where it matters. By the time we'll have done our value add and we'll sell the property, we're done. Ouch. Seriously, ouch for those. So I feel bad for those sponsors, because honestly, they're not trying to do anything wrong. They just made a really bad bet, and that bet is not panning out. And then the refinancing challenge that becomes part of this, right? So a lot of us, when we did floating, almost everybody, in fact, either has the idea that you're going to sell it within a couple of years, or you're going to refinance into a fixed rate agency loan. And that's where it's become a little tricky, right? Because as I said, agency fixed rate loans, you're lucky if you get 60%, maybe 62, 63, 65% at the most. Asset valuations have gone flat, right? So because of that, if you took a floating rate loan, bridge loan for 70% LTV, and now you're getting a 60% leverage on the fixed rate agency loan, you've got a gap. There's cash you'll have to put into the property in order to be able to do the refinance. And as if that is not enough, they need a 1.25x debt service coverage. With interest rates going up, even on the fixed rate, it's harder to meet that debt coverage now, right? So again, just giving an illustrative example from the same example that I've been giving so far, that a 60% on the 10 million, the 14 million asset is 8.4, which still leaves a gap of 1.6 million that you need to get from somewhere to pay off the bridge loan, right? And then at a 5.5% interest rate, which is what the prevailing rates are right now for agency, the monthly NOI, reverse engineering that, needs to be at 59,000. And if you remember, the highest we went up to was 54,000. And with rental growth and all of those things flattening out a little bit, it's harder to get to that NOI to be able to meet that 1.25x coverage, right? The one thing I'll mention in passing, not get into it too much, is the option for preferred equity. This is this group of funds out there that will offer you money to meet that gap. If you have that $1.6 million gap, for instance, in refinancing, they'll meet that gap. But in exchange for that, they will take a preferred position on the capital stack right behind the lender on first making a certain percentage on their money before you get any cash flow out. And that fixed percentage can really be hard. It can be as low as like 4 or 5% to as high as 7 or 8%. It basically could eat up all of your cash flow. It could still help you survive. So it's not a bad thing, right? If it helps the deal survive and sort of go past this current slowdown period, it's not a bad option. But then you have to also remember that they put in covenants and caveats in there where if you don't meet certain metrics under certain circumstances, they can take control of the property away from you. That's a risk that you have to worry about if you don't know what kind of pref equity provider it is. There are predatory providers out there who are in the business specifically to come in, offer you the pref equity, wait for the moment you don't meet even one metric for a month, and next thing you know, you're out. They've taken over the property from you. Your investors have lost everything. So it's very important to really vet out the pref equity providers and not blindly jump into it because it sounds great, right? So this is just a note of caution. I'm not saying there's enough pref equity providers who are there to do the right thing. They're just taking advantage in order to make a better return for their LPs, right? So that's okay. But what are we doing to manage the short term, and what I think most operators need to focus on, right? So first of all, we have to focus on keeping operations steady. All indications right now are that the markets should start settling down next year, right? Even though we know that right now the Fed is still a little bit hawkish, especially after the jobs report. They're talking about a few more rate hikes. The reality is that there's enough evidence to show that inflationary pressures are coming down. So there's a lag for the inflation to slow down enough for it to show. So I fully expect that the inflationary pressure will start lowering through the year, and as they see evidence of that through the second half of the year, that next year things will start settling down. It might be another year though before we really see a steady state. So it could be 2025 perhaps, but our goal has to be to manage operations as efficiently as possible in this period, and just stay with our nose to the ground, right? Just not panic. That's the most important thing. The second is to build up, cash reserves, right? Conserve cash, build up the reserves. Pausing distributions. I know it's not a good thing to say. I know it's hard. Investors, many investors are not happy about that, but honestly, it's in the best interest. It's in the best interest for your capital, best interest of the property, and the best interest overall for your portfolio to see that the sponsor is taking the responsible decision of pausing distributions and focusing on cash conservation. As Kavita was talking about, cash management is really tricky right now. So the more you conserve cash, the much better health you're going to be in, either when you want to buy a rate cap extension and you may be able to afford it at that time, or if you find that you need to refinance and there's a gap and perhaps the reserves can help you meet that gap, right? Many ways in which that reserve that you build is going to help you. Find ways to reduce expenses, right, across the board. And resident retention. Earlier, the focus was a lot on driving rental growth. With rental growth having tampered down a little bit, resident retention is more important because that reduces your turn cost, your cost of having to redo the unit for the next resident, right? And then look everywhere you can for more revenue, whether it's bulk cable, Wi-Fi, corporate housing. I think, Kavita, you talked about that, right? So every avenue you can find, do that. And then, question, is it still a good time? The answer is always yes. And beginning, I said there's one statement I want to make, and this is what it is. Invest with people you trust and within a trusted circle, because I think that is the key. A lot of people did well in the last few years just because the market was rising. The rising market, all boats were sailing, everything was going well. But when things don't go well, when, not good things hit the fan, that's when you want to be in partnership with people that you can trust, people that you can depend on, people who are going to look out for you, people who will pick up the phone and talk to you when you call them. That's what I would say. I wouldn't, multifamily is clearly part of the housing industry, which is a must-have, right? Everybody needs that. So it's not like retail where things can go online. People need to have a roof over their heads. There's a and I'm sorry, I didn't mean to say $4 million shortage. I meant 4 million units of shortage. That's a mistake in there. But there's 4 million units of shortage in housing in the US based on the Freddie Mac report. And they say that it's going to take a decade to meet that supply. In that time, the gap is going to increase. So the demand isn't going anywhere, right? And then if you look at the 40-year history of multifamily, it's one of the most reliable commercial asset types compared to almost any other. I know that in the last 4 years, industrial has been outperforming multifamily, but industrial has its own caveats on what kind of industrial does well, when it does well, and what can affect it, right? So just because it's had a boom period in the last 4 years doesn't mean that it's going to keep booming. You got to be careful. Multifamily, on the other hand, it may go up and down the ranks of how well it's performing, but it has rarely lost money for people. It has rarely not beaten inflation. Only time that happens is when the sponsors make some extremely terrible decisions, or you have made the misjudgment to invest in a deal with someone you didn't know, which is why come back to that. Make sure you trust the people you invest with. And then finally, how would you evaluate deals to invest in, right? So location is important. Make sure it's a resilient market, not a market that is so up and down in its swings that you only make money when it's going up. That, in some markets, people who invested in 2007 before the 2008 recession, they didn't make up the money for almost like 12 years. You don't want to be in that kind of market. You want to be in a market where, 2, 3, 4 years, 5 years maybe, you can wait it out, but then it usually withstands a recession, right? Demography is important. You want to avoid assets where the demography may not be able to, deal with a recession well enough where your delinquencies go through the roof and it starts hemorrhaging cash. Make sure the deal is well capitalized. Now that you're getting into a new deal, the existing deals need to start ensuring that they build reserves. But if it's a new deal you're investing in, make sure they're going in well capitalized and not depending on building that capital later. Be open to long-term holds, right? I mean, we have to get out of the time frame that we've had in the last few years saying all 2-3 year kind of tones, right? Everybody's made money, great. But now you have to have staying power, and that'll determine the winners. And then the nature of the deal and the debt, right? So loan assumption deals are great. Like if you've already buying a deal where it already has fixed rate loans at a certain set amount, and it's predictable, and where you know that the economics will make it work, that's great. Affordable housing is an area where there's tax benefits that could offset other kinds of increases. Rate cap, let's make sure you're buying it, and that of course it's hard to predict how much to bet on for that. But then lower leverage, right? Not every deal works with this, but if a deal does work, it might actually be great to park cash, right? And once again, same thing, invest with people you trust. So rush to that a little bit, Kavita, but I wanted to keep it open so that we can have some questions.
Awesome. I mean, that was very, very comprehensive. Thank you. I think you hit every point that I could think of. That was amazing. So if anyone has any questions at this point, I think we are kind of at the top of the hour. We've crossed our time here, but want to make sure that you guys understand what's happening here. And I think I did a phenomenal job of that. So the question which came in earlier, I think has been answered, why people invested, ultra low rates and all that. So let's talk about, this was an interesting one. As it's very hard to find value add projects today, what is your view about ground up multifamily construction projects in today's market?
Yeah, look, I think ground up multifamily construction, I think is a great opportunity. Because one of the things I spoke about just like 2 slides ago was the fact that there is a huge gap, a huge shortage in supply of multifamily units or just housing units in general, right? So anything that comes up now is going to contribute towards trying to meet that gap, and it's going to do well. The market that you invest in is going to be important. You want to make sure that there are some markets perhaps that did end up with an oversupply. We don't know yet because those reports are still awaited. But markets like Dallas, markets like Houston, markets like even North Carolina, Raleigh, Charlotte, Phoenix, Austin to some extent, but depends on where in Austin, because Austin sort of has always been this little closeted area which the values sort of really grew. Now, as it spreads towards San Antonio, my feeling is that the supply there will start doing well. So I think market will really be important for that. And the reality is that if you start multifamily construction projects today, you're probably not going to get done for another 1.5 to 2 years before you really hit the market in terms of providing the supply. And as I said, the indications are that we'll be in a much more stable environment in 2 years' time, where those projects should really do well. The real question is, can the project actually do well in the construction phase itself, which is, can it get the kind of construction loan that will allow it to be healthy? That's really the biggest question there.
Yeah. And that was an interesting topic, actually. I discussed with another multifamily sponsor recently who's actually doing new projects, and we are also working on some new multifamily construction. What's interesting is right now, because of the uncertainty about how much Fed's going to increase rates, the spread is much larger on these loans, right? So you're kind of, let's say the spread is 150 basis points. Lenders are taking a 300 basis point spread right now. But let's say Fed says in 6 months, hey, we're done with interest rate increases. We're going to let this trickle down and take effect at this point. We're going to see the spreads coming back down. Yes. So it might not be the best time to start a multifamily construction right now, or, you really can't time the market, right? So if your numbers can work with the lending rates, and if you can actually get lenders lined up, I think that's the challenge right now. Yeah. But it might be advantageous. And in this sponsor's case, I was talking to him, he actually did like the analysis to see, okay, if in 6 months the spread reduces, which he's betting on, He's like, my project is going to be so many millions dollars cheaper because we're getting debt at like 100 basis points less or whatever. Even accounting for the fact that the Fed might go up another 50 basis points, right? Or 25 basis points is what we're anticipating. So I think it's kind of anybody's guess at this point, like where the ship will go, but we're just like holding on, saving cash, cutting corners wherever we can. So it's
that's
interesting.
Because the problem is also in a construction loan is what kind of a loan are you getting, and how is the interest rate being set? If it's truly floating throughout, then actually that's an interesting hedge that you have to worry about, but where perhaps it works in your favor as the spread goes down.
Right.
If they give you a fixed rate, well, that makes you feel better. The question is, are you going to be stuck with a high fixed rate?
Right. Yeah. It's hard to make a good call, right? Like we don't know what we don't know. We anticipate something, but your guess is as good as mine. So we're all like shooting in the dark. So
Earlier, I was on a call with a potential bank for a construction loan, and they were telling us that they want a year of the interest.
Yeah.
Escrow in advance.
Yeah. We have done that on some of our land projects. We had to escrow 2 years of interest upfront. We're like, take it. Right now we're kind of happy because we're like, okay, we don't have any worry about that for 2 more years, but it was painful at the beginning because we had to cough up so much cash. Okay. So yeah, it's been I think the people who survived this can live to tell, right? Like 2008, we're like, we survived this, so it's a rough time. So I think to wrap it up, as Ike said, be patient, and real estate is really a patient game, right? It's not like I want cash right now and I want it now. Sometimes it's better to pull back on those cash flows because you want the health of the property. You want capital preservation first. We're not in the short-term business of like, okay, let's distribute and then put the property at risk, right? So anyway, thank you so much, Ike. This was really, really amazing. And, as always, I didn't expect anything less. So I knew it's going to be, I think there was a comment here saying, this is a great critical information that newer GPs should know about, because there are a lot of people with rosy lenses right now thinking everything's good. I can go into this property, this underwriting looks good. Yeah. You really need to look at what's the reality of the market right now. So thank you all for joining. Thank you so much, Ike, for your time. Amazing presentation.
Thanks for inviting me, Kavita.
Thank you. And everyone, thank you so much for sticking with us. Most of you stayed the whole hour, so appreciate it. Webinar will be on YouTube. Thank you so much. I'm glad it was useful, and I'll be circulating this to all my investors now. So if they have questions, like go watch this webinar. So thank you all, and thanks for joining tonight. I will see you in 2 weeks. Good night.
Thank you. Bye-bye.
Bye. Hi, I'm Kavita Bartake. I hope you found this video useful, and if you did, please don't forget to subscribe to my channel so you can get notified of any future videos I upload. I plan to cover a lot of investor education on this channel, and I hope you'll stay with me for it. If you have any feedback on future content you'd like to see me cover, please drop me a note or a comment on my video. Thank you for watching, and thank you for supporting me.